here? All right, we got the screen up. Okay. All right, everybody, we're here for the January 2026 Dynamo Capital Fund update. We've got the founder, Justin, on the phone with us here to run through the numbers. And we're going to get started real fast. Go through the disclaimer. This is not an offer to invest or any promise of future returns. Just some good information about what's going on to our existing investors and anybody else that might be in the background looking and trying to learn more. As always, you can go to our data room or at vycapitalgroup.com/data room and look at historical data and all the information out there that's for you to do your own due diligence. We are still accepting capital. This is going to be ongoing for up to 12 months or as long as Dynamo Capital continues taking money. We do have soft commits, so if you're interested in jumping in for the first time or even adding to your position, if you are adding to your position, we had this question come up recently, you do not need to do that in the $100,000 increments. You can do smaller increments once you've already met that first threshold on the minimums. So keep that in mind. And then, yeah, this is a monthly capital raise, so feel free to share this with folks that might be interested. And then we're gonna jump right in with Justin here. He's the CEO, managing partner, and let him tell us how January went.
Yeah, so January was an interesting month for us. It was generally a little bit slower. Everybody's in real estate knows that everything tends to slow down a little bit towards Q4 and Q1. And we did feel a little bit of slowdown in volume, but we still had a really solid month of RTL origination volume, which was great. We started to move into a couple of different geographies as well to start to expand our education and a few other key metros that we feel like to be pretty interesting and exciting, namely in the Texas markets. They're very lender friendly. They're very mature in terms of their the lending landscape that's out there. So we just started to deploy a little bit of capital into a couple of markets around the Dallas Fort Worth area. And going to ultimately see how those markets move and how they function before we start to deploy considerable amount of capital into those markets. But um, we've also been very pleased at the operational efficiency at which our team has been operating recently. Files are moving through the system in a much more efficient manner. There's less underwriting exceptions. There's much less restructuring. Files are moving through the system at a much more efficient pace, which means our sales guys are doing a great job. They're putting the right information to the systems. Our technology build out has been doing exactly what it's supposed to do, right? Everybody utilizes, everybody loves technology until it doesn't work right, as we all know very well on this call. Um, but our team has been really focusing on building up the tech stack in the right way and ultimately to provide more efficiencies, and that's what we've been seeing over the last call it 6 to 8 weeks now is okay, the technology we're putting in place and the systems we're putting in place are creating more efficiencies. They're not creating, more steps just for the sake of having more steps. And that's been a very nice thing to see. So our focus for 2026 is going to be, building out our sales organization and imagining what that actually looks like. Me and Matthew have been spending a tremendous amount of time building out what our philosophy is when it comes to building out a sales structure. We've been very blessed with the salespeople we have internally that we all think very similarly, and they're very much so they're very collaborative in the way that they think. Those folks are pretty unique in the sales world. A lot of sales folk just want to get out there and start pounding the pavement and putting as much through the system as possible. And so we're working through a way to construct the sales organization in a way that allows us to have our cake and eat it too, in some capacity. How can we get the best salespeople that we feel are the best fit for Dynamo, and also let them go do what they want to do, but also stay true to the fact that we don't want to pay people on a per file basis? And how do we structure compensation in a way that allows us to get those guys and ultimately not cap their upside, which a lot of salespeople want, right? That's why people get into sales because they want to go out and make the most amount of money that they can based off the amount of work that they do. but how do we remove the negative incentive of closing people on a commission basis or paying people on a commission basis? So putting a lot of thought towards that, and it really starts at leadership level, right? We need to have really good, strong sales leadership. That's not myself and Matt. Find the right leaders that align with that philosophy and come up with a creative way to compensate people in a way that we feel like makes sense, gives them what they want in terms of upside, and then ultimately find the right people to fill those seats in the target geographies that we're looking for. So a lot of thought has been going into that and what that means, and we're beating it up from every different angle and talking to a lot of different sales leadership candidates to ultimately find the people that align with the right philosophy for us. So that's something we're very, very, very focused on today, and we will continue to be focused on as we continue to build this sales organization out.
How many sales folks do you have right now?
We have four. We have four today. We just hired a new loan officer that'll be starting in March, and we just hired a managing director for the TPO channel as well. He starts technically tomorrow, but we've been interfacing with him for the last month or so. So he will be building out TPO versus retail, right? Retail is going to be direct to consumer. So we're boots on the ground in that market, originating actively, very heavy on the RTL side of the business. And TPO channel is going to be working more B2B. So working directly with mortgage brokers, commercial loan brokers, right, who are doing their outreach to their particular clientele. That's going to be very heavy on the DSCR side of the business.
Gotcha.
So kind of slightly different way of thinking. Same operational rails, same underwriting philosophy, everything stays the same, just a different way of acquiring the customer.
Okay. I'm glad you explained that. I did not know what a TPO was.
It is a very, very big segment of our business, or in private lending just in general, right? There's a lot of brokers out there. It's very difficult to become a lender, so most people are brokers. That's where me and Matt came from, was we were in the broker world. And so historically we haven't necessarily pushed too hard in that field. But we feel very confident based off of the tracks that we've put in place in terms of our credit policy and our ability to underwrite and our ability to process loans effectively, that we can open up that channel. We've also unlocked a couple of different liquidity sources in the DSCR and RTL space that we feel make us very, very competitive compared to our contemporaries. That we can go to market and capture additional loan volume that way without taking on any excess risk.
Awesome. That sounds great. All right. Well, then I guess let's just jump into January's actual figures.
Yeah, so I won't bore everybody by just reading the numbers. We ended up doing about $850,000 in fund profit last month. Slower origination month, though a little bit lighter on the origination fees, but the high origination months over the last couple of weeks, or not couple of weeks, excuse me, last couple of months, has increased our interest revenue about $150,000 a month, basically every month. So that's the nature of building up a bigger book, right? As we add more to our loan portfolio, our interest revenue is going to increase in the coming months, and that will continue to happen, obviously, as we continue to do good RTL business. So, still stepping on the gas in terms of the DSCR origination. That's obviously why we're having the conversations in the TPO world now that we feel very, very comfortable with our ability to acquire the customer, underwrite that loan, process that loan effectively, and trade that loan into the secondary market very, very quickly. Now we can go out and get more customers. Now we can go out and build the sales volume, right? There's no use in our heads of just slamming loan volume in for the sake of slamming loan volume in, because ultimately we want customers to come back to us and have a good experience, and for us to be able to do what's right for the client, and also not have it take 75, 90 days to get a loan done, right? That's not a good customer experience. We want to be closing loans in 3 to 5 weeks on average. And we finally have driven that timeline down, and we feel confident we can do that at a higher scale. And we're going to start seeing the yield spread revenue increase over the coming months. It's not going to be tomorrow. It's not going to be this month. It's not going to be next month. But we're building those pieces today to be able to drive that DSCR revenue a lot more effectively over the next couple of quarters.
Do you have an idea what the average between your RTL book versus your DSCR book is, like percentage wise? Like, is it 50-50-ish? Is it, I
In
don't know.
terms of volume today,
Yeah, just kind of your portfolios.
oh, it's probably 95% RTL today.
Oh, still. Okay. So we've got kind of even
Yeah. So
better.
we've really been focused on the operational capacity and sending enough volume through the system that we can capture enough data points to know where the system is not working before shoving everything into the system. Um, could we go out and get more volume today? Yeah, we could go hire 50 salespeople tomorrow if we really wanted to, and go out and just flood the system with volume. Um, but that's not beneficial for the longevity of the company, right? What we're really focused on today is building the operational track for us to be able to get from sale completed to loan funded to loan sold. And that is what we're trying to really understand. There's a lot of inputs that go into it, right? Where are loans falling through? Where are the issues with loans, right? Are we having issues with trading any loans, right? If we are, what are the challenges there, right? We don't really get feedback on that until we're trying to trade a loan, right? So we have to go through, and that takes, from soup to nuts, right? If it takes 30 days for us to process and underwrite a loan and 30 days for us to fund that loan. It took the loan officer maybe 30 days to actually acquire that deal in the first place and get structured to the point where the term sheet is signed, right? We have a 90-day cycle from the time like we get a loan to the time that we actually get real-time data on, okay, how did this loan actually do and perform? And then another 30 days, or excuse me, another 3 months before we're out of the early, the EPD period, which is early payment default. I'm getting really into the weeds of this right now, but uh, I'll wrap this up quickly. But we have another 3 months before our liability in that loan is expired per se, where we may have to buy that loan back. And so really we have about 100, let's call it, that's 90 days, another 90 days. We have about 6 months for us to really gather all that data to know, is our underwriting process working effectively? And do we need to make any tweaks? So we're finally on kind of that period of time where now we've seen that first kind of 6 months worth of loans kind of work through the system, and we haven't had any EPDs, and things are going quite well. To the point now, it's like, okay, let's turn the sales volume up. Let's see what tweaks we have here. We're going to expand that loan volume, right, to hopefully that 10 to $12 million a month mark is kind of our target. Let's get some more data points with a higher clip and see what that looks like. That'll bring up probably overall origination volume to, or DSCR percentage to RTL percentage somewhere in the, call it 30 to 40% range of total origination volume,
Okay.
before we continue to open up that spigot again. So it's, hey, let's get more data points. Let's see where things start to break again, and let's turn the spigot off, or not turn the spigot off, but let's slow the spigot down and then fix those issues and then turn the spigot back on. It's a constant back and forth of, right, what's the right amount, right, of volume to origination capacity that we can take on. So
Makes total
um,
sense. Okay.
yeah.
Oh,
So I think I did well, I guess on the next slide, but yeah, in terms of volume, yeah, we did about 15 and a half million dollars in total loan volume, average loan amount of 1.1. It's a little inflated. We did a couple of loans that were portfolio loans, so it was multiple assets in one loan. So it drove the loan volume, the average loan amount up a little bit. But overall, our per unit value still, I think that one of these portfolio loans was 8 assets. So
okay.
um, ultimately, the numbers look a little bit inflated in terms of the averages, but still roughly in line with what we would typically anticipate.
Gotcha. Okay. Let's see. I think the next one is LTV. So
Yeah.
you're getting that.
So yeah, still steady around that 65-ish% loan to value range, which we like, right? We don't believe this is a total indication of portfolio performance, but it's certainly an equity moat that we have in the event that the market takes a dive for whatever reason, which we don't necessarily anticipate in the markets that we're in, that the market's going to take a dump anytime soon. But it's certainly what we like to call an equity moat around any sort of market movements in a short duration of time.
Got it. Well, looks like it's pretty steady. So I guess next question is, what do you think for Q1 and going forward? I mean, we touched
Yeah.
on it
Yeah,
a
we touched on
little.
it obviously a little bit earlier in my rant there, but yeah, we're focused on continuing to increase our capital markets efficiency and capture both additional revenue that we could be gathering through just better trade partners, but also expediency of trade, right? There's a fine balance of revenue to timing of revenue, right? I may want to, I may want to wait an extra 5 to 10 days to get my capital back if I can make an extra 100 basis points. But if that number is 10 basis points, then maybe not, right? There's certainly a time value of money aspect that we're really leaning into, and we're building out some pretty sophisticated models internally to decide, right, what's the right balance of expediency. And there's some very interesting opportunities in both the RTL and the DSCR sector to increase the efficiency at which we can deploy capital. More to come on that soon. As I mentioned there, we don't have anything finalized there, but some pretty interesting capital market strategies that I think will allow us to continue to increase our origination volume without taking on any additional balance sheet risk.
Got it. When I think, a question we get occasionally is defaults, and I haven't asked in quite some time. How is that looking at this point?
Yeah, so our default ratio has actually been very steady over the last several months. We had a couple of loans that slipped into a 90-day DQ, but that it was one client who had three loans with us. He just brought all those current, so he was the only DQ that we had in the portfolio as of the end of January. The defaults that we do have in place today are the same defaults that we've had, and most of those are moving into foreclosure or are actively being foreclosed upon. So nothing new there. We have a couple of REOs that we're holding on the balance sheet today. One of which I actually just signed a purchase contract for today to be able to get that off of our books, and the other one is that same buyer is actively looking at the other one as well. So we won't take any capital losses as well, so that's always great. So that's exactly the story that we want to be able to tell when we take REOs back. So we've been looking good on that side of things. We'll continue to focus more on that as more default and call it loss mitigation scenarios present themselves. We don't have a dedicated team for that today. It's our servicing team that handles all of that. But as our book continues to grow, if our percentage remains the same, it'll become there'll be more units for us to have to do that with. We'll start to build out a loss mitigation team that only focuses on default scenarios and foreclosures and all that good stuff. So hopefully we don't. Hopefully we can continue to minimize that percentage and we don't ever have to build that team out. But realistically, we probably will at some point in time. Just the sheer volume of them will require a team to be focused on it.
Gotcha. Yep, I definitely remember the workout teams from my banking days.
Yes.
So, all right. Well, this is the return metrics. This is me. So for RVY Capital Group investors that are actively invested, for January, the fund return was 1.82%. And what that equates to for a Class B, somebody that has more than 250,000 invested, is a 1.64% return. And then Class A was 1.46 for the smaller investment. So another solid month, tracking to exceed a little bit the target of 16.8 and was it 18.9? So obviously, and this is what you're thinking is probably gonna be a slower quarter. So we'll take it.
Yeah. Yeah, I think Q1 will be a little bit lighter in return. I think probably right around this same neck of the woods. And I think that I would expect to see an increase probably towards the tail end of Q2 as we start to get into the more aggressive summer months, typically speaking. So
Yeah.
now we may get a little bit more, depending on how interest rates move, we may see spring buying season maybe a little bit more active than it has been in the last couple of years. But we'll see. We'll continue to position ourselves in a way that we feel we can capture as much market share as we can.
Awesome. All right. Well, as always, we appreciate your time. I know you're
Of
busy,
course.
so next time I'll get my camera working faster.
No worries at all.
Please, always.
Thank you guys as always, and happy to always chat.
All
So
right. Have a great week.
thanks,
Thanks.
guys.
Bye.
Bye.